Supply and demand zones are one of the most powerful tools in smart money trading. Many profitable strategies are built around them, and they have helped countless traders grow their accounts over time. But here's the problem. Most traders struggle because they don't know how to identify these zones correctly. That's why learning how to spot real zones and ignore market noise is such a critical skill for every trader. Welcome to Graph Insight. In this video, I'll show you how to identify supply and demand zones that actually matter, and how to use them inside a clear, step-by-step trading strategy demonstrated in real market conditions. First, let's clearly define what supply and demand zones actually are. Supply and demand zones are areas on the chart where price made strong, impulsive moves due to smart money entering the market. On the chart, this usually looks like sharp moves up or down. However, not every strong move creates a valid supply or demand zone. That's where most traders make mistakes. To separate valid zones from invalid ones, we focus on two core criteria, and the first one is the presence of a fair value gap. A fair value gap forms during a strong, impulsive move made of three candles. In a bullish move, the high of the first candle does not overlap with the low of the third candle. In a bearish move, the low of the first candle does not overlap with the high of the third candle. The price range between those two candles is the fair value gap. The candle that comes right before the fair value gap defines the boundaries of our supply or demand zone. This is the zone where smart money activity is most likely concentrated. The second key criterion is that price must create either a break of structure or a change of character. Before we move on, let's quickly recap these two concepts. A break of structure, or BOS, happens when price breaks a previous high in an uptrend or a previous low in a downtrend. It confirms that the current trend is continuing and that market control remains the same. A change of character, or CHOCH, occurs when price breaks a key level in the opposite direction of the trend. This signals a potential shift in market control and is often the first sign of a trend reversal. Simply put, break of structure confirms continuation, while change of character signals a possible change in direction. Now let's look at this example. Here we can see multiple consecutive bullish breaks of structure. This tells us that the market is in a bullish trend. After each pullback, price reacts with a strong move to the upside. On the first break of structure, price creates a fair value gap. On the second one, it does not. This means that only the first demand zone is valid. Later, price moves lower and breaks the previous major low, forming a change of character. At this point, we say that a supply zone has been created. The boundaries of this supply zone are defined by the candle that comes right before the fair value gap. Now that we understand how to identify valid supply and demand zones, let's talk about why we mark them and how to actually use them in real trading. Once we identify a valid demand zone, we expect price to return to that area in the future and react from it, driven by remaining buy orders inside the zone. In this bullish scenario, we can see price retracing back into the demand zone. At this point, we do not enter immediately. Instead, we wait for confirmation of a reaction from the zone in the form of a closed bullish candle. This part is important. We do not place limit orders inside supply or demand zones. Price can break through a zone and continue moving in the opposite direction of what we expect. That is why confirmation is always required. We only enter after the market shows a clear reaction and confirms a potential reversal. Once confirmation is in place, we enter a long position. The stop loss is placed at the lower boundary of the demand zone, and the take profit is set at 3 times the stop loss distance. This gives us a risk-to-reward ratio of 1 to 3. This ratio is considered an unofficial gold standard among traders because it allows you to remain profitable over time, even with a win rate of around 35 to 45%. Now let's look at a bearish scenario. On the chart, we can clearly see a downtrend confirmed by consecutive bearish breaks of structure. During the last impulsive move, price forms a fair value gap together with a break of structure. This tells us that a valid supply zone has been created. The boundaries of this supply zone are defined by the candle that comes right before the fair value gap. The logic is simple. Institutional players make their decisions before the imbalance is created, and that activity is reflected in this candle. After that, price retraces back into the supply zone and forms a clear bearish confirmation, shown by a red candle closing down. At this point, we enter a short position. The stop loss is placed at the upper boundary of the supply zone, and the take profit is set at 3 times the stop loss distance. From here, we can see price respecting the zone and moving exactly according to our scenario. Now that we've covered the most common market scenarios, let's look at a more advanced and less frequent setup. This one has a higher probability because it combines a market reversal with a liquidity sweep. Let's break it down step by step. First, we need a clearly established trend that has been respected for a long period of time, confirmed by consecutive breaks of structure. In this case, we are dealing with a bullish trend. However, instead of continuing higher, price reaches a previous major high and performs a liquidity sweep. This happens when price breaks above the high with a long wick and then quickly reverses in the opposite direction. This long wick represents manipulation by smart money. Price moves in the expected direction to trigger buy orders and stop losses, and then rapidly shifts direction. After the liquidity sweep, we see a clear change of character, followed by the formation of a fair value gap. This confirms that market control has shifted and that a valid supply zone has been created. This supply zone is the key level in this scenario because it forms after a liquidity sweep and a structural shift. A return to this zone has a higher probability compared to standard setups. When price retraces back into the supply zone, we wait for bearish confirmation, shown by a red candle closing down. For a more precise entry, we can drop to a lower time frame and wait for confirmation there. This allows for tighter risk and more accurate execution without changing the overall bias. We enter a short position after confirmation. The stop loss is placed at the upper boundary of the supply zone. The take profit is set at 5 times the stop loss distance. This risk-to-reward ratio is justified in high-probability setups like this one. As an alternative, we can scale out of the position, taking partial profit at a 3-to-1 ratio and leaving the remaining portion to run toward the 5-to-1 target. This is not just a simple supply and confirmation setup. It is a chain of factors working together. First, we have a long-established trend confirmed by a series of breaks of structure. Then we see a liquidity sweep above the previous major high. This is followed by a clear change of character, showing a shift in market control. After that, price creates a fair value gap, indicating strong displacement and inefficiency. And finally, a supply zone forms after the manipulation, not in the middle of the move. This means we are not trading a correction or a pullback. We are positioning for the beginning of a new market phase. And that is exactly what logically allows us to target a larger risk-to-reward ratio. Thank you for watching. If this breakdown helped you see the market more clearly, make sure to like the video and subscribe to Graph Insight. Let me know in the comments which concept you want me to break down next. I'll see you in the next video.